So I want to be very clear at the start of this video. I don't make this video to stoke anyone's premonitions. I don't make this video to spread fear. I simply make this video because I think there is a reasonable risk out there that you need to know about. I could be right, I could be wrong. I hope I am wrong. I hope this does not turn into a black swan event, but the risk is higher than a lot of people would like to acknowledge. Specifically tomorrow, Thursday, and Friday. In particular, you're seeing some very bad things as far as hedge fund positioning being the most short you have seen since 2020, even though in 2022 markets fell 30% on the NASDAQ. Why are we so short now? Why does the chart leading into Black Monday in 1987 look literally identical to what is happening in our markets? Why is that? Why is it that Wall Street has delusional expectations about economic growth, at least in my personal opinion? And we get big data coming out here in the next couple of days. So we are going to cover this. Hopefully you guys learned something. At the very least, hopefully you are more informed of what could be to come here in our markets. And this is relevant as of now. Tomorrow could be the start of potentially a multi-day black swan event. The risk is too high to ignore. On top of that, surprisingly, we have quite a bit of Tesla stock news to get into, including Elon Musk literally saying Ford, GM, and Stellantis are on a fast lane to bankruptcy. We have all of this, and as you know, much more. Hit the like button and subscribe to the channel if you are an investor in Tesla, if you want to grow your net worth, if you want to make as much money as possible, or at the very least, stay up to date with the good, the bad, the everything in between that's happening in the markets and with Tesla stock each and every single day. So we're going to start this video with a chart. This chart on the left side is 1987 and Black Monday. Black Monday, stocks fell 20%. And really, the 3 days leading into Black Monday were very big declining days as well. And what you'll notice here is these charts, this is a chart of our markets now, look identical, literally identical to what happened Black Monday or the week of Black Monday. If you even look at specifically this period that we are in right now, I screenshotted this to blow it up so you guys can look a little clearer on where we are. So if you look at the S&P, right, this is what's happening right now. If you pull up the chart that I screenshotted, literally down to what happened yesterday, it's identical. You've seen a bounce before ultimately things hit the fan. Take a look right here. This green looks pretty similar to right here if I were to say so myself. Pretty similar style kind of bounce. And then what happened? What happened on this candle that is important to kind of point out? You fell under this bounce level to close near the low. And that is exactly what happened today. Now, if history repeats itself, the next couple of days could be quite red. Now, history does not always repeat itself, but it usually does rhyme. Black Monday, you fell 20% in a single day. I wouldn't expect we would fall 20% in a single day. So the relevance of 1987 to now, everything's different in the markets. The structure of the markets, the psychology of the markets, the investor in the markets, it's all different. But this is way too similar to ignore. The second thing that I would like to point out is from the short bear over here on Twitter. It says hedge funds added their biggest short exposure since 2020 this past week. This is coming specifically from fundamental long/short hedge funds. This is extremely out of the norm and to me looks more like FOMO/panic than a bad omen. So basically saying something here. People are starting to panic under the surface. And here you have it. You're way down here. Throughout all of 2022, when the NASDAQ fell 30%. You were not this net short ever. You were only this net short back in 2020 and then back in 2008. So this is not great considering markets, in the grand scheme of things, are still trading at very elevated levels, even after the decline that we have seen in the last couple of days. The short bear also points out here on X today that positioning in the NASDAQ 100 is now one-sided and it's net short at 8.1 billion, with all long positions being unwound. This is from Citibank, and this is the NASDAQ 100. The put option activity is soaring. The put to call ratio is at 1.7. That is excessive. For context here, Tesla's put to call ratio is 0.84. Tesla's highest put to call ratio you have ever seen was about 1.8. And that was back here in January of 2021 when Tesla bounced back higher to retrace this longer term downtrending line. So even on a stock that is the most shorted single stock in the markets, you still do not have a put to call ratio of 1.7. In fact, it is less than half of the put to call ratio on the S&P 500. Now the question is, why is this happening? And the answer is quite simple. We are to some degree in a lose-lose situation. If inflation falls to 2%, but the economy continues to do well, and there's no recession, things are business as usual, the Fed made it very clear they're not going to lower rates. They'll keep raising rates until the economy starts to look poorly. Well, if the economy looks poorly and we go into a recession, sure, the Fed cuts rates, but what's that matter? We're already in a recession. And I think that's what the markets took out of the press conference last week. That's why stocks have really been selling off, because it became very clear. There's no winning outcome here. The markets were hoping that as inflation gets close to 2%, the Fed would say, hey, the economy can be fine and we'll get inflation to 2% and we can cut rates in the process. As inflation comes down, we'll cut rates. That's not what we got. But indeed, there is a possibility of a black swan event coming based on this same logic. Let me explain this a little bit further. The next couple of days, I believe you could see, it's possible, a black swan event. Do I think it's the most likely outcome? Well, no. But I think the odds are too high again to ignore. So let's back it up a little bit. Why does the Fed believe they might need to raise rates again, keep rates higher for longer when inflation has come down a lot from 9%? It's because the economy has been doing so well. If you take a look at the Atlanta Fed GDP Now tracker, the average consensus estimate for Q3 GDP in 2023, the quarter we are currently still in, is 3%. 3% GDP. I've talked about this before, but back on June 27th, the average estimate for Q3 GDP was 0%. So borderline negative, borderline starting a recession. So what then happens if we start to get Q3 retail sales data, personal spending data, personal income data, durable goods orders that are really disappointing? Well, your expectations for 3% GDP could turn into 1% GDP, could turn into half of 1% GDP, could turn into negative expectations for GDP. That's where a potential black swan event could occur. You don't even need to necessarily see a negative Q3 GDP report to get a black swan event in the markets. It's all about expectations. Expectations are far too high heading into the economic data that we are going to get over the next couple of days. 70% of GDP comes from the consumer spending money. So that's how you get GDP estimates. We've seen July's numbers really good. Now we're starting to get more August numbers. If those don't come in as great as people think, we're going to have a major problem on our hands. Tomorrow morning could start that major problem. You are going to get durable goods orders month over month for the month of August. Again, keep in mind, these estimates are high for GDP because of July's good economic data, good spending data. While durable goods for August month over month, you're expecting negative 1.4%. The key here really is last month was negative 5.2%. So if you are 5.2% negative or worse coming tomorrow, then you have a huge problem on your hands. That's where you could really get a black swan event. If this number were to come in at negative 7, negative 10, then people are going to say, whoa, GDP is not going to come in at 3%. We could be heading into a recession by the end of this year. I bet at that point the Fed would change their tone a lot. Then on Thursday at 8:30 in the morning, Eastern Standard Time, you are going to get the GDP growth rate, the final numbers for Q2. Remember, when you get a GDP report, or really any data from the government, you get the initial number, and then there's 3 revisions after that. Or at least 2, depends on what data point it is. But usually 3 revisions. So you could get a 2% GDP number, and you could see that revised down to 1%. Or you could get a 350,000 payroll number, and the markets will react to it that day. But a month and a half later, well, your 350,000 jobs you thought you added is really only 100,000 jobs. And that's actually what you have seen in the payroll data. So a lot of the numbers that we are really used to hearing that are in our memories don't look nearly as good for a lot of the data that we have gotten. It's because the revisions have mainly been to the downside over the past 12 months. This final revision, you're expecting GDP to increase 0.1% and hit 2.1% for Q2. The last revision we got was 2% even. So if that gets revised down, that's another potential problem area or problem data point for our markets. On Thursday, you are also going to get a speech from Fed Jerome Powell at 4 p.m. If he changes any of his language, if he kind of walks back anything that was said on the FOMC press conference, that could be positive for markets, but odds are that's not going to happen. A lot of Fed speakers we have heard from since the FOMC press conference, Fed Daly, Fed Collins, Fed Goldsby, a couple of other Fed speakers, Fed Kashkari today, have all been pretty unanimous in we might need to raise rates further, but at the very least, we're not cutting rates anytime soon. Now, Friday's economic data is by far going to be the most important, but durable goods orders tomorrow is also very important. This data Friday comes out at 8:30 in the morning. You are going to get personal spending month over month. This is a big one. You're expecting 0.6% personal spending. Last month's reading was 0.8%. Last month's reading was the highest number that you have seen since January of 2023. If you exclude January of 2023, this would have been the highest number in January that you have seen in the last year. So no wonder GDP expectations are 3%. You've seen really good data for July. If this data comes in negative, that could also be a potential black swan event. Now, for a black swan event, a true black swan event where it causes, I don't know, a 10% down move within the course of just a couple of days for the indexes, that's what I would kind of categorize as a black swan event. You would need to see these data points be deep negative. Like personal spending month over month would need to fall 3 to 5%, 3 to 10%. Then, yeah, I would expect a huge down move in the markets. You're also going to get PCE data, headline, and the core month over month and year over year. Now, I don't think this is nearly as important at this point because the Fed has fully acknowledged to markets it doesn't matter if inflation comes down to 2%. We need to see weakness in the economy. So even if inflation does come down, we still need to see weakness in the economy. You can't be too happy on that, but it wouldn't surprise me if the markets did react positively on a beat to CPI, at least the initial reactions. I would be very weary to say that would be a multi-day kind of bullish effect. So this is what I believe could give us, to some degree, a black swan event. Again, it's based on 3% GDP expectations. 70% of GDP comes from the consumer. We haven't got the month of August data yet, so we're starting to get those numbers. If those numbers disappoint in a big way, in which I think there's actually a quite high likelihood that they do, your GDP estimates are going to come down a lot, and people are going to be asking the recession question a lot more. And that could lead to a lot more selling. That could lead to a very bad market. And it's all based on really high expectations, potential for data to come in really bad. That's what this is based on. I don't know if anything crazy happens out there. If something happens in China, in Europe, Japan, or any other major economy that could affect us, that's also going to be important, but you can't forecast that. You also heard from Fed Kashkari today. He is notoriously one of the dovish or most dovish voting members of the Fed. He said today there's a 60% of a soft landing and a 40% chance of not. Now, what he actually said, some of the other quotes here, do not sound great. He says, or he was asked this question, once supply factors have fully recovered, is policy tight enough to complete the job of bringing services inflation back to target? Kashkari said, playing this less rosy scenario forward, quote, it might not be, in which case we would have to push the federal funds rate higher, potentially meaningfully higher. Quote, the good news is that we don't need to make this determination right now, Kashkari said in the essay. We can observe the actual progress in bringing inflation down over the next several months to determine which scenario is the dominant one. These remarks from Kashkari came today. What also happened today is JP Morgan Chase CEO Jamie Dimon had an interview with the Times of India, out of anyone, the Times of India, and says rates could go as high as 7%. He goes on to say that I'm not sure the world is prepared for 7%. He said, according to a transcript of the interview, I ask people in business, are you prepared for something like 7%? The worst case is 7% with stagflation. If they are going to have lower volumes and higher rates, there will be stress in the system. We urge our clients to be prepared for that kind of stress. Quote, I would be cautious, Dimon told the Times. We have to deal with all of these serious issues over time, and your deficits can't continue forever. So rates may go up more, but I hope and pray there is a soft landing. Wolf Research cautioned Tuesday that the benchmark note could hit 5% before the end of the year from its current level near 4.5%. So the way that I'm thinking about markets right now is simple. There's no good outcome here. The path forward for the markets, whether we bounce, we trade sideways, we crash from here, is uncertain. But we know eventually that crash is coming. We know eventually we will go into recession. That's why markets are selling off right now. The big question is when? When do we go into a recession? This data coming this week could give us a lot more insight to when that could be. If data comes in really bad, a recession could be by the end of this year. Whereas still a lot of Wall Street does not believe a recession is coming at all. Now, I will be the first to say I don't want a recession. That's the last thing I want. The last thing I want to see is Americans struggling, losing their jobs, facing divorce, losing their house, their cars, not able to see their children as much as they did before because maybe now they're divorced because everything went sideways in their lives. I have 2 kids of my own. The last thing I want to see is a recession, okay? But I'm not going to lie to you like the Fed, the government, Wall Street, or anyone else. I'm going to tell you how it is. If Dollar General on the weekly chart looks like this, is $15 lower than their Rona low, you're not avoiding a recession. Let's be honest there. Dollar General, out of all companies, can't do well right now. Are you serious? Are you kidding me? It's bad. It's real bad. And it's probably going to get a lot worse. Again, hopefully I am wrong. I don't want to be right on this, but it's just the fact. Let's now get into some Tesla stock news. Zero Hedge on X says Biden says he agrees the UAW should get a 40% increase just in case the US needed some more inflation. Elon Musk responded to this and said, quote, they want a 40% pay raise and, really emphasizes, and a 32-hour work week. Sure way to drive GM, Ford, and Chrysler bankrupt in the fast lane. Geesh, if this is Elon saying they could be facing bankruptcy, that's pretty bad. I think if anyone would know, it probably would be Elon of what kind of effect that would have on their auto business, considering that's mainly what Tesla does today. You can already see this taking a massive toll on the auto suppliers. As of today, auto suppliers are urging Biden to provide financial assistance to address the strike, to, quote, effectuate federal assistance to ensure the viability of this crucial industry sector. Without federal assistance, the ability of the automotive industry to resume full manufacturing capacity is at risk. Basically saying operations will be a lot leaner with a lot fewer employees if this deal with the union does go through the way that the union wants it to. The letter cited immediate concern for smaller suppliers with revenue of less than $200 million. It urged the Biden administration to establish a small business administration program or other agencies to, quote, maintain workforce and operational capacity. This is having a real effect on the economy. Again, something the Fed will not acknowledge, but it's having a broad effect already. Not to mention if the strikes last until November, as some experts believe they could. Volkswagen to temporarily cut production of 2 EV models due to weaker demand, according to a spokesperson. They will suspend production of the ID.3 and Cupra-born electric cars at its Zwickau and Dresden plants in Germany in the first 2 weeks of October due to weaker demand, a spokesperson for the car maker said on Tuesday. Production will be suspended from October 7th and resume on October 16th. Volkswagen declined to comment on the number of employees affected. The carmaker said earlier this month that it would not extend the fixed-term contracts of 269 employees at its all-electric Zwickau plant. Not sure if I'm saying that right. Zwickau plant. Gary Black also wrote here on Twitter, responded, really reposted Justin Horn. He says Wall Street doesn't pay for aspiration. That's why there are so many retail millionaires now from Tesla. Gary Black says exactly. I don't include any value for Robotaxi, Optimus, or FSD licensing deals in my Tesla $320 price target. Imagine if any of those 3 upside options hits. And that's where you get a dramatically higher share price than his price target of $320 per share. If you guys have not noticed already, we are over here on X. I had to make a new account. Just everything went wrong with the old account. So go ahead and follow the new account if you have not done so already. Simply type in Michael Tyler and you will find it. So before we go ahead and conclude this video, I just want to put in a little bit of kind of clarity on what I think could happen if data comes out really bad this week that shows maybe we are going into a recession right now. Just something that is not in the least bit priced into the markets. You're starting to get a recession priced into the markets, but it's not right now. It's not in 2023. We're expecting very good growth for Q3. If that does not happen, you could have a problem on your hands, and you could have it on your hands quickly, aka this week. It's a possibility. I don't hope that happens. I don't want to see a recession, but it is a possibility. Now, in order for me to really call this a black swan event, you need to see like an 8%, 7% fall. You need to see a big drop in markets over the next coming days. Now, a 7-8% drop in the markets would be, for the most part, pricing in a recession is right around the corner, which you would have to see some really bad economic data. So I'm not going to go out on the line or on a limb and say that is what we are going to see, because I don't know if the data is going to be that bad. But I do think it's possible that we get a little bit more confirmation of a recession, that we could easily fall back to the 410 level on the S&P 500, potentially to about $400 on the SPY. That would still be a fall of about 6% on the SPY in just the next couple of days. Now, obviously, if that chart of 1987 plays out the same way as it did in 1987, well, they look pretty identical. Could be a precursor to more downside to come in our markets on top of everything else that we have covered here in this video. With Tesla, I'm a lot more bullish on Tesla. Tesla's technicals themselves look a lot better than the broader markets. You're still above your 100-day moving average. You're within 2% of your 50-day moving average. This looks beautiful compared to the S&P. But if you do see a big down move in markets, Tesla stock could also fall huge, especially if it's over concerns of a recession. 220, 200, that could possibly be in the cards. To the contrary, if this data is good, well, I would like to say you get a reaction, an upside reaction in the markets. But if the data is good, that just means the Fed's going to raise rates more and interest rates are going to go higher. That's to my point. There's no win here. It's just, there's no win. So hopefully you guys learned something here in this video. If you did, let me know down below in the comment section. Let me know what you think about the path ahead for the economy. Hit the like button as well as subscribe to the channel. If you guys would like to come trade with me live in real time, get access to every time I make trades, hedge out the portfolio, go long, couple YOLOs here and there. Link down below in the description of this video. You guys enjoy the rest of your day. My name is Michael Tyler, and I will see you in the next one.